Hello and welcome to this Chapter 3 overview video where we're going to take a look at the adjustment process. And by way of a little bit of context, remember that where we are right now, in the last chapter we learned how to record transactions using debits and credits in the journal, and then we posted them to the ledger and we created a trial balance. Now we're going to continue the process and see what happens at the end of the period. So here are your learning objectives for this chapter. The ones that are bold are the ones that we're going to be talking about in this video. So we're going to look at the difference between cash basis and accrual basis accounting. We're going to talk about adjusting entries for deferrals and accruals. We're going to learn how to prepare an adjusted trial balance, which really is not different from the trial balance that you saw before. It's the same process. And then we'll take a look at where we are in the accounting cycle. So first, let's take a look at when revenues and expenses are recorded. This has to do with cash basis versus accrual basis accounting. Remember that we need to prepare financial statements in accordance with GAAP, generally accepted accounting principles, right? So the revenue recognition principle says revenues are recorded in the period in which goods or services are provided to customers. You might also hear that worded as when the performance obligation is satisfied. This is GAAP. This is how we record revenues when we are preparing our financial statements. Now, expenses are recorded in the same period as the revenues that they helped to generate, and this is sometimes called the matching principle. So we're going to take a look at some specific examples that'll help you with this. All right, so let's look at the difference between accrual basis and accounting, and accrual basis accounting and cash basis accounting. So we said accrual basis records revenue when goods and services are provided and expenses in the period that the costs help to produce revenue. This is part of GAAP. Okay? So these are the rules that we are going to be using. Now, cash basis is not part of GAAP. Cash basis says you only record your revenue when cash is received and you only record expenses when cash is paid. So that does not work for GAAP. We're not going to be doing that, but you might see cash basis accounting. For example, if someone had a very small business, they might keep their records on cash basis because that's closer to the way that we prepare taxes, is mostly cash basis. But for big corporations, and if you need financial statements, say to go to a bank and you need GAAP financial statements, you have to follow these rules. All right? So now, when accrual basis and cash basis happen in different accounting periods, we're going to need adjusting entries. All right, let's look at some examples of accrual basis versus cash basis accounting. Some very simple examples as to when the revenue and expense will be recognized. Joe's Mo's does landscaping for its customers on May 13th. The customer pays Joe on May 30th. All right, so accrual basis accounting, when can Joe recognize his revenue? Hopefully you said to yourself on May 13th, because that is when the goods or services were provided, and the revenue recognition principle says when the goods or services are provided, he can recognize revenue. Now, the customer doesn't pay Joe until May 30th. So the cash basis accounting says recognize revenue when the cash is received. So cash basis says you can't recognize revenue until May 30th when you get paid, right? Remember that if you were recording this with debits and credits, if he did the landscaping and he didn't get paid, he would be recording a receivable right here on the 13th. And then on the 30th, he would be recording the collection of the receivable. Now let's look at some expenses. Let's say Joe's Mo's buys and uses some supplies for his business on March 26th, but he doesn't pay for them right away. He pays for them on April 8th. So what he did was on March 26th, he's going to record a supplies expense
and he's going to record a payable, right? Because he didn't pay it yet, right? That's the accrual basis. So when do the expenses help him earn revenue? Well, on March 26th, right? Because he used them to do whatever he was doing that day, some landscaping. Maybe he bought some mulch for his customer. So he used the supplies on March 26th. That's when he records the expense. If it were cash basis, Joe would not get to record the supplies expense until April 8th. All right. But in this case, he would have recorded the right way to do it, according to GAAP, will be record the expense and the payable here, and then on April 8th, you record the payment of the payable. All right, so let's look at an example of how this all ties together. We start out with the transaction during the period, right? These are all of the transactions that we saw in the last chapter. So let's look at this particular example. In this case, we are buying supplies on account. We're debiting supplies. Supplies is an asset. It's going up. We're crediting accounts payable. Accounts payable is a liability. It's also going up. Remember, assets have normal debit balances. Liabilities have normal credit balances. All right, so that's a transaction that happened during the period. Now, what happens is, during the period, these supplies are getting used up, right? But every time somebody goes and, say, takes a ream of paper out, they're not going to be making a journal entry for that, right? That would be very cumbersome. So what they're going to do at the end of the period is the company's going to say, all right, how much do we have left in our supply cabinet? Oh, we only have $400 left. Okay, well, we can't be showing an asset of supplies on our balance sheet of $1,000 when we only have $400 left. So we have to make an adjustment. All right, so what is our adjustment? Well, we have to reduce our supplies account, right? Because our supplies is showing 1,000, but there's only 400. So we're going to credit our supplies for $600. And we're going to debit our supplies expense. Supplies expense is for the amount that you used up. All right. Then the financial statements, we're going to look at this really in more detail in the next chapter, but the financial statements are prepared using the adjusted amounts. So the supplies on the balance sheet are it's going to show the correct amount, which is that there's $400 of supplies, because you have 1,000 minus 600 gives you 400. Your income statement is going to show the supplies expense of $600. So the adjustments fix your accounts and make them reflect what reality is, right? So this is helping us to reflect reality here. And reality is what we want to show on our financial statements. All right, so this has a little star on it because it's very important. There are 3 basic rules for adjusting entries, and these rules will help you when you're making the adjustments and you're trying to decide what to debit and credit. Remember these rules, okay? Number 1, adjusting entries are prepared at the end of an accounting period before financials are prepared. So remember, we did all the transactions, and then you get to the end of the period and the company says, okay, which things are off and need to be adjusted before we can report our correct numbers. Every adjusting entry affects one balance sheet account, either an asset or a liability, and one income statement account, either a revenue or an expense. So if you have half of your adjustment, like for example, let's say here we knew we had to credit supplies to bring it down to 600. Supplies is a balance sheet account. You know you're looking for an income statement account as the other part of your journal entry. Finally, no adjusting entry affects cash. I like to tell students that cash is a 4-letter word, which is like a bad word when you're doing adjusting entries. The transaction happened earlier, right? This is the transaction. If you would have paid cash, this is the place you would pay cash. That's not what we're dealing with now. What we're dealing with is an adjustment that's going to affect either an asset or a liability, but not cash, and a revenue or an expense. There are a few videos and there is a lot of practice for you in our guided notes.
This is really important because the adjustments, this takes a little bit of judgment here, and you're just learning debits and credits, right? So adjustments do tend to give students a little bit of trouble because there's a lot of decisions to be made, which is why you have many videos and lots of practice in your guided notes. So please use those guided notes to practice. All right, so there are two types of adjusting entries. There's accruals and deferrals. Now, accruals, think of an accrual as a pulling entry. It's pulling. We're pulling the revenue or expense into a period before the cash is received or paid. Okay? So we're going to record the revenue or expense in one period. We're going to record the cash received or paid in the following period. So accruals are pulling the revenue or expense into an earlier period. A deferral is pushing the revenue or expense into a later period. So in the deferral situation, the cash is received first, and we push the recognition of the revenue or expense into a later period. So accrual is a pull, deferral is a push. Let's look at some examples of adjusting entries for accruals and deferrals. Let's take a look at some revenues first. So here's an example of an accrual adjusting entry. AJE is adjusting entry. Debit accounts receivable, credit service revenue. So accounts receivable is an asset. It has a debit balance. It's going up. Your service revenue has a credit balance. That's also going up. So what happened here? Well, what happened was the company got to the end of the period and some revenue had been earned, but it hadn't been recorded yet. So maybe we did some business for customers, but we haven't sent out the bill yet. So they want to record the revenue in this period. We're pulling the revenue into this period, even though we're not going to get paid until the following period, right? We have a receivable. Now, an adjustment for a deferral would be a case where you had gotten cash ahead of time, but you hadn't earned the revenue yet. Again, make sure you look at the other videos where we have specific examples. So what might have happened? Let's say the Yankees sold a bunch of season tickets before the season started, and then when they played a home game, they earned some of the revenue that they had not earned before, and hopefully they won. So they are debiting the unearned revenue, which is a liability. This is a little tricky one. When they got the money, it was a liability because they hadn't done the service, but they got paid. Now they're reducing their liability and they're recording their revenue because they played a game and they earned the revenue. All right, let's look at some expense examples. Almost every company has a salary accrual at the end of the year. The reason is that this comes about when your employees have worked, but they haven't been paid yet. So imagine, most companies, and I'm sure you have the same situation if you work, you don't get paid the day you work, right? I get paid every 2 weeks. Maybe you get paid every 2 weeks or twice a month. So at the end of the year, the company has to record the salaries that employees have earned, but they haven't received yet. They haven't gotten paid. So the company hasn't paid the employees, but the employees have earned the money. So they debit salaries expense and they credit salaries payable. Remember, this is a pull entry. We're pulling the expense into this earlier period, even though we're not paying the employees until next period. All right, so anytime you have an accrued expense, it's going to be a debit to an expense and a credit to a payable. Now, a deferral would be, an example would be prepaid rent. So prepaid rent would come about if the company had paid its rent ahead of time, right? So last period, they paid for the rent, and now some of it has expired. So they're reducing their asset account. Prepaid rent's an asset. It has a debit balance, so we're crediting it to reduce it because it's not prepaid anymore. It became an expense. All right, so this is a typical expense deferred expense entry, and it's similar to the supplies. Okay,
All right, so once the adjusting entries are recorded, like our salaries expense entry, of course, just like all journal entries, they are posted to the ledger. Now, let's look here. So what happened? Well, this company had $3,600 in salaries already that they recorded during the period. But now at the end, they're putting in this adjustment. So they're adding, and of course this gets posted, right? We're posting this here. The debit becomes a debit, the credit becomes a credit. And now this company has salaries expense for the period of $4,800 because they had already paid their employees $3,600 and now they owe them another $1,200. So on our income statement, it's going to show $4,800 salaries expense, and the salaries payable on our balance sheet, that's a liability, that's going to be showing at $1,200. Once all of the adjusting entries have been prepared and then posted to all of the accounts, all of these adjusted balances go on to another trial balance called the adjusted trial balance. So here's an example of an adjusted trial balance from your book. The adjusted trial balance shows all of the account balance, all of the adjusted account balances. So, for example, let's look at our salaries expense, right? Our adjusted salaries expense, remember, was $4,800, and this is showing our salaries payable of $1,200. It is in the same order as the other trial balance that you did, the unadjusted trial balance. It starts with assets in order of liquidity. So of course cash is always first. Now remember, cash wasn't adjusted, right? Cash is the same number that it was on the unadjusted trial balance. So here are all of your assets, followed by liabilities, followed by equity, revenue, and expense. And of course, your total debits have to equal your total credits. So the adjusted trial balance is prepared after all of the adjustments have been journalized and posted to the ledger. These are the numbers that we're going to use to prepare financial statements. We're going to look at that in the next chapter. So let's just review where we stand in the accounting cycle right now. So the company starts with some beginning account balances, right? So in this case, let's say they had accounts receivable, that was from last period. It's sitting there, and then we have some transactions during the period. They did perform some revenue on account here. The transactions get posted to the ledger, right? This is everything we did in the last chapter, and we prepared the unadjusted trial balance. All right, so those are all the things we did before. Now we're adding these two new things. At the end of the period, we prepare our adjusting entries, and then after they're all prepared and posted, we prepare our adjusted trial balance. We're going to add some steps onto this in the next chapter. We're almost done with the accounting cycle, but we're going to add a couple of steps here, and like I said, we're going to use the adjusted trial balance. Is very important because those are the numbers that we use for our financial statements. All right, so that's all I have. Please make sure you watch the videos. Adjusting entries are tricky. Make sure you're going to put in the time to learn them because, as I said, it's going to take you a lot of practice. Okay, see you next time.